Good afternoon. Welcome to Green Bicep. The signal from the noise. This is week number 12 of 2023. Thank you for being here with me today. The last week was wild. Volatility all over the place. Today, the banks were rallying big, but tomorrow the Fed meets, and this may be the crash that I'm expecting. This may kick it off tomorrow, depending on what the Fed does, and I would say we run down for quite some time. It will be a flash type crash, and just be ready. Tomorrow should kick off. You'll know around 2:30, 3 o'clock if it's happening. And then by 4, it'll be confirmed. Market will sell off quite hard. So that's kind of exciting. The reason for that, we'll get into it. So the market resumes its downtrend, and it's in the upper portion of a channel. I have a target of 3075 on the S&P 500. And that is a function of the contraction of bank lending, as well as just high multiples in general in the market. And that would bring the PE down to a lot lower level. Last time I checked, we're around 18. Historically, you could go as low as 7, but that obviously is not quite near. Before I had it coming down to 15, and that's quite a bit lower than 15. I think it's so. But you know that's where. So that's based upon technicals as well as fundamentals. So I'm not just looking at fundamentals. I look at the technicals as well. So confidence has been shattered. So the market is shaky regardless of what you're seeing today. The volume was actually quite weak as it rallied. So I call this as a head fake, I would call it. And in the morning, it's a great opportunity to purchase some puts. I mean, that's not financial advice. It's just that's probably what I'm going to be doing, or at least I'll be watching it closely. Yeah. So the banks that have gone under or distressed, Silicon Valley Bank bankruptcy on March 17th. What is a red flag for the bank is that they held a lot of securities called held to maturity securities, and so they weren't marking them to market, and that was 91. It says M, so that's got to be a B. 91 billion of 212 billion. That's 43% of their book. So they're essentially not pricing quite a bit of their book. And then someone wanted funds because they were held in these securities that are not liquid, like mortgage-backed securities. They couldn't convert it to cash quickly enough because interest rates spiked up and the price of them went down, so they would have to sell at a loss. So there's just a combination of a lot of things going on here. Duration matches and such. So they couldn't fulfill, and word spread pretty quickly. Signature Bank, First Republic Bank, Sweden has a lot of exposure, as well as Credit Suisse. So this is spreading. Ultimately, the reason why, there's a few reasons, but the first one is that a lot of banks took your cash and they invested it into different types of securities, and those securities dropped in value, so they don't want to sell them and mark to market, and it would be a loss. And so that's one of the reasons. Then a lot of these have their loan books aren't great too. If you look at their loan books and look in the specifics of it, there's different tiers of capital, and like level 3 is the worst, and a lot of them have quite a bit of level 2, not so much 3, but that is an issue as well. So, another interesting thing I found that I looked at a group of banks, and of the group, 9 banks had directors leaving between December and March. Most of them were in Jan and Feb. But so all these directors having to jump ship before everything blew up here. So it's to me that seems really strange, because it was like, say, a sample of 15 banks, and of them 9 had the directors leaving before this happened. Tomorrow, if the Fed is smart, they wouldn't raise rates, but they're probably going to do 25 points just because they're saying they're data dependent. So we'll see how that goes. if they don't raise rates, that would signal to the market that things are weaker than the market is. It would signal things are weak, and that would probably cause a sell-off. Either way, I think we're going to sell off hard. It doesn't matter what the Fed does. In 2023, oil is under pressure. However, because of no investment in capital stock, that should help price in the second half of the year, especially if we get the fiscal stimulus. So if we get fiscal stimulus, plus there's some QE going on behind the scenes, there's a potential, like, depending on how bad this banking crisis is, we could have inflation. If it's a severe crisis, that means London's really going to seize up, and then the inflation's just going to drop like a rock, because the economy will. Same as last week, we have the data's been weak and out of China's. And then, interesting enough, Putin and Xi met, and to potentially to work on the Belt and Road Initiative, to look at the strategy. Continued alignment of the East, that means the east side of the hemisphere, and also Ukraine's timeline. How is winter 2023 to 2024 going to look? How are they going to plan that? So here is the historical bank failures going back to about 2000. You can see between 2008 and around 2015, there were quite a few failures. So looking at 2023, just expect this to start to tick up. It may not be quite to the level of having like 500 or so banks fail, but we're going to have quite a few. And the reason why is if you just look at their financials, I mean, there a lot of them, there's zombie banks out there. Well, I mean, the easiest way to state it, they're zombie banks. I mean, if people wanted their cash, they couldn't get it because they're underwater. And then some banks are over levered, not quite zombie, and so there's just different levels. And here you can see the discount window. This is banks borrowing directly from the Fed, and you can see when comparing it to prior crisis and another crisis, you can see 2008, we actually surpassed that. So the banks are that more fragile, I would call it. So people at home like that are watching this should be like, okay, this is not going to probably pull too well if you experienced 2008, since we're already past that and the amount of banks are requested, and they were only requested if they need it. So this is from Game of Trades. This is showing that how the Fed's balance sheet expanded quite a bit in a short amount of time. It's not a huge dollar amount, but if we look at this next chart, the Fed's balance sheet has a high correlation to the stock market. So this should be good for the stock market. So we're going to wash out tomorrow. The crash will begin. We'll bottom around say May 1st into June will be the bottom, and then from there we're going to have a decent amount of QE and possibly fiscal stimulus. That's what potentially could push the market extremely high in 2024. It just depends on the stimulus. If we don't get it, the market's not going to do much of anything. And then that's a whole different scenario I'll have laid out. So we got to get to those points first. So I'm kind of bullish on 2024, even though we're about to crash and the banks are going to get destroyed. And yeah. And so here's a Game of Trades again. I borrowed this from him just on the correlation between essentially the balance sheet of the central banks, or the G4 central banks, and the S&P 500 is 97% correlation. So that means when they expand their balance sheet, the market goes up. So the market's likely going to eventually go up. But first we got to wash through this banking crisis. Even Norway's central bank, they have 129 billion invested in financials all across the world. So this is, and then Credit Suisse just blew up. We know about that. And so and then I was looking at a Japanese bank, one of the largest. They have exposure to, basically their balance sheet is defunct. I mean, it's just broken. And they actually have 16% of that company is owned by like American institutions. So that's 16% of the largest bank in Japan. Yeah. So this is just a big issue. And so for Credit Suisse, though, specifically, These are the fines they paid by year. French share this would be, and so up to 700 million in 2022. So they were just washing money, doing whatever they want, and it was time for them to go. And so next we're going to get into inflation. So this is breaking it down a little bit more in detail, looking year over year on inflation by the main buckets: food away from home, energy, commodities, energy, services, as well as commodities less food and energy, commodities, as well as services less energy, services. But the point is, inflation is quite hot still. I was quite surprised by this. This is year over year, and this is month over month. Month over month for this energy, it's pretty damn massive. And the food too. Yeah, so we got pretty good inflation kicking. That's CPI. Then when you look at the CPI and you, on the lower part of this chart, it's year over year percentage change. So you can see over here where I'm circling, this is energy services. And then up here you got food. And then you got food away. This is food at home, I believe. If I could read what I wrote. Yeah, this is food at home. So food is up like 10% year over year, which is tremendous. And month over month, it was up, 0.5% or so. But the point is, there's surprisingly a lot of inflation. And then what I did next was I took the consumer price index and I pulled it out and I weighted it somewhat how my budget is. And it ended up, instead of being inflation at 6%, was at 7.2 for me personally. And it might have been, that's just my mix, but so inflation's a little distorted in how they're weighting it. And it doesn't include taxes too, which would kick up my inflation probably over 10%. Yeah, so the inflation's still there, but with the banks coming down and contracting, and lending will stop, and so it's complicated. And there's more inflation. I watched this. This is globally: France, Turkey, India, Japan. And prior, there was quite a few red colors in here, meaning I was just looking quickly. I scan this and see if anything jumps out. But it's all turned green, so inflation's kicked up again. That jumped out at me when I was reviewing. So global inflation's real. And then we got the wage growth is continuing to drop down. That's likely going to continue to drop down as well. Unofficial sponsor, Monster. Sorry. It is actually quite late. It's almost 11. It's 11:17 p.m. So gotta stay awake. So yeah, I don't think wage growth is going to be a problem, just given how things are getting weaker. That's going to continue to trend down. The real problem is food, as you can see. Food here and here. It's just year over year. It's just high, and inflation is looking at is a time measurement. So it's looking at the prior year or prior month. And so, yeah, it's not good. I mean, as long as the trajectory is heading down, meaning it's going 7.654, then you're okay. But this is just, it's just hot. And then when you break it down by all the different buckets, like I said, it was 7.2 overall versus 6%. But you can see, like, it's just, inflation's just all over the place. Shelter, airfare. Yeah, it's just, where you do see a lower inflation is in apparel, inventory build likely, used cars, and trucks as well. And then we get into Baker Hughes rig count. Sure enough, it dropped more, so this is good for oil prices if you want them to go up. There's no incentive to invest in the capital stock and CapEx in the United States, so companies aren't going to do it if they're worried about being taxed on their profits. There's no incentive versus paying out in a dividend or a stock buyback. Incentives is what drives decision making ultimately, good or bad incentives. And so this is the a sentiment indicator, and it looks like we're still on the greedy side, so it's not at a max or min yet, and so we'll see. Continue to watch that, and we're still at a point where the yield curve has not broken yet, but my understanding is the midsection of the yield curve is starting to correct itself, and typically when that happens is when the market washes out, and we'll get to that too. How interest rates, they have started to drop, and that's typically when the market drops too. So if the Fed does 0% or drops rates tomorrow, the market's going to get destroyed. If the Fed raises rates 25, the market will like wallow around probably until Friday, then Monday, Tuesday next week it'll wash out, something like that. But it's going to be a little slower, in my opinion. We've looked at this every week. This is the 10-year minus the 2-year. We're down at this point still, and kind of flew through this pretty fast. So net exposure is basically extremely low. I'm actually probably negative now. I just didn't calculate it. I expect the S&P 500 to drop to 3,075. Currently, the 3-month bill is at 471. It was, I'm sorry, it is at 4.7. It was at 4.8, and prior to that it was at 5. Yeah, so it is at 471, but it went from 5 to 4.8 to 471. And so the yield curve is starting to correct itself. The 2-year is at 4.19, 4.179. Next week I'll have that on there. I'll keep a running count. Same thing, cash is king. Everybody's finding out now, but we're getting at a point where if we get a big enough dip on May 1st, you might want to be going long hard on some of these names that you like, and you'll you know, Buffett will be out there as well hunting on the banks. Gold, store of value. Silver, I would consider it just a technical trade if you do it. That's my take on it. Bitcoin is store of value as well. People, something about Bitcoin I was looking at recently is that people complain about volatility. I was talking to someone, we're talking about how a lot of people look at their 401k statements once per quarter. So I took a look at Bitcoin on a monthly chart and then a 3-month chart, and it's actually not volatile if you look at it from that perspective. It's actually just like really smooth. So Bitcoin it's all about time frame, right? You could look at a 1 second chart, 1 minute, 5 minutes, but if you look at a monthly chart on Bitcoin, it is not that volatile like when you spread it out. And I guess from a Sharpe ratio perspective, looking at the volatility and return and volatility together, the Sharpe ratio of Bitcoin I think is higher than all asset classes. I know it is for this year, but I think over like the last 10 years as well. So even given with a crazy amount of volatility, it's still higher. And the reason why is that the stock market, the S&P, could correct from another 20-30% from today. It's extremely volatile as well, especially if you own some of these stocks. You're feeling it as we speak. Well, today was a good green day for most. That was on low volume. So the play here, I'm just gonna the play here really is, today's a good day to buy puts before the Fed talks, and just go out several months, and most likely this is going to wash through and you'll do quite well. That's the play in having cash. I would consider even Bitcoin, the miners as well too. I've been talking about them for a while. Those are the smart plays, in my opinion. Yeah, like I closed out my last Tesla put today, and the reason why is I just think there's better opportunity costs in other places, and Tesla might rally. You never know. Like, I do expect the market to crash, but at the same time, Tesla could jump up 20 or 10%, then swing back down, and it's just very volatile, and it's appearing to be stronger than a lot of other tech names. But in this drop, I would expect tech to get hit as well, quite hard. There's names like Roku that just fundamentally they just aren't looking very good, and eventually that's going to wash out, especially if the bank they use to source them, the financing, went out of business. So then they need to find a new bank, and that might not be easy to do. So companies of that nature that were using Silicon Valley may have trouble getting new financing, especially if their numbers look horrible, like a lot of these tech names that I mentioned, like Roku, for example. Workday's on there as well. And that is it. Wow, we flew this really quickly. Let's look at commodities. Let's see what's happening. We have eggs up 114%, but for the week, let's see, eggs are actually up more. What? Up 12.7. But overall, it looks like livestock is not up that much. Aluminum, metals look okay. Actually, on this, it's interesting. Inflation on the raw input side has definitely come down. So that's what's happening, is inflation has come down for raw input, but the companies are holding prices up, and you could see that in the grocery stores and such. So there's an imbalance right now between input costs versus what is the retail store is selling. So that will normalize itself likely in the next few weeks as this market washes out. So big picture where we're at is we're in a bear market. The banks are blowing up. You want to be in cash. We're likely going to bottom in May to June timeframe. That's when you want to go long. It would be more of a trade. And if we get a lot of QE, quantitative easing, and fiscal stimulus, we could take out the highs and run. Now, if they constrict that, we may end up going into the sideways pattern, and we could be back at Dow 10,000 by 2032 if they constrict money supply too much. So there's a concern that they may do that. So we're either going to go left or right, and it depends who's in charge. And we'll find out here. It's going to be exciting the next few months to next few years, actually. I appreciate your time. If you like the content, give me a thumbs up and subscribe, and I'll talk to you next week. Thank you, and don't hesitate to reach out with questions or comments, and I'm happy to answer.